If you regularly transfer money in Australia, whether that's paying a tradesperson, sending money to a family member, paying a bill through your banking app, or moving money for something as big as a house deposit, there are 3 new rules that have quietly come into effect around you, and most people using their banking app every single day have no real idea any of this has changed. This isn't overseas news. This is happening inside Australian banks right now, in 2026, and it directly affects what happens the next time you hit send on a payment. Today, I'm walking you through the 3 biggest changes, what they actually mean the next time you make a transfer, and exactly what to do if one of them catches you out. Before we get into it, if you're not subscribed, do that now, because scam and banking regulation in Australia is moving faster right now than it has in years, and if you're not across it, you can either lose real money to a scam or misunderstand a new rule that's actually there to protect you. Let me start with a quick story, because it puts all of this in perspective. A tradesman in Sydney, in his mid-20s, had saved for years for his first home deposit. He received what looked like a completely normal email from his conveyancer, formatted correctly, referencing his actual property purchase, with a legitimate-looking Property Exchange Australia form attached. He transferred the deposit exactly as instructed. It turned out to be a scam, and he lost $109,000 in a single transfer. That case happened before some of the protections I'm about to walk you through were fully in place. The 3 rules in this video exist specifically because stories like his kept happening again and again across the country. The first rule is confirmation of payee. This is the one you've most likely already seen without fully understanding what it actually does. Confirmation of payee is an industry-wide service that checks the name of the person or business you intend to pay against the account details you enter, and it notifies you before a transfer is made if the name on the receiving account doesn't match what you typed in. It started rolling out from July 2025, with the major and mid-tier banks implementing it first, and other deposit-taking institutions, including credit unions and building societies, following by the end of that same year. Here's exactly what it looks like in practice. The service activates the first time you make a payment to a new BSB and account number. After you type in the account name, and before the payment actually goes through, a matching service checks whether what you've entered lines up with the recipient's real bank details and shows you a match result on your screen. If it comes back as a match, you proceed as normal. If it comes back as a mismatch or an unable to verify result, that's your signal to stop and check before you go any further. This matters more than it might sound on the surface. As of early 2026, the service was already live across more than 80 financial institutions, covering over 143 million bank accounts across the country. Australians had used it more than 100 million times since launch, and one bank alone reported over 450,000 payments abandoned by customers after receiving a no-match result. Here's the number inside that number that really matters. More than 10,000 of those abandoned payments were headed straight to accounts already listed on the Australian Financial Crimes Exchange, meaning the system genuinely caught people in the act of sending money directly into a known scam account before it left their hands. What this means for you, practically, is this. The next time you set up a new payee, especially for a large amount like a house deposit, a car purchase, or a big family transfer, don't just click through a no-match warning because you're in a hurry, or you trust the source. That warning exists precisely because the name you typed doesn't line up with what the bank has on file for that account, and it is very often the only thing standing between you and losing everything, the way that young tradesman did. Take the extra few minutes. Call the person or business directly on a number you already know and trust, never one taken from the email or text that gave you the account details in the first place, and confirm before you proceed. The second rule is the Scams Prevention Framework, and this is the big structural change sitting behind everything else. This isn't just a bank initiative anymore, it's now federal law. The framework has been built directly into the Competition and Consumer Act 2010, with fines reaching up to $50 million per contravention. The ACCC acts as the general regulator overseeing the framework. ASIC specifically oversees the banks, and ACMA oversees the telecommunications companies. In plain terms, banks, telcos, and digital platforms are now all legally on the hook together for stopping scams from reaching you in the first place, rather than simply cleaning up the mess after you've already lost your money. What changes for you as an everyday person sending money is the standard these institutions are now legally required to meet. It's no longer acceptable for a bank to just process a transfer and shrug afterwards if it turns out to be a scam. Under this framework, banks are expected to run active detection and disruption systems, including confirmation of payee and outbound payment scam monitoring, essentially checking for warning signs before your money ever leaves your account. So if a transfer looks unusual for your normal account activity, larger than what you'd typically send, to a brand new payee or at an odd hour of the night, don't be surprised if your bank now pauses it, calls you directly, or asks you extra security questions before letting it through. That extra friction isn't a glitch or an inconvenience, it's happening by design, and it's the direct result of this new law being taken seriously. The third rule is the one with real teeth for anyone who's already been scammed, and it's the compensation pathway. This is the part almost nobody currently knows about, and it's arguably the most important one. Consumers who suffer a financial loss because a regulated entity breached its obligations under the Scams Prevention Framework now have a direct, formal route to compensation. In banking specifically, that path runs through AFCA, the Australian Financial Complaints Authority, acting as the external dispute resolution body, and banks are required to be AFCA members for scam disputes by the 1st of September 2026. What this means in plain English is genuinely significant. If you get scammed and your bank failed to meet its legal obligations under this new framework, whether that's failing to properly flag a suspicious transfer, failing to run the checks it was required to run, or failing to intervene when clear warning signs were present, you now have a formal, legally backed pathway to pursue getting your money back through AFCA, rather than simply hoping your bank shows you goodwill and refunds you out of the kindness of their policy. This is a genuinely different position to where things stood only a couple of years ago, when banks had far more discretion about whether to reimburse a scam victim at all, and plenty of people were simply told the money was gone, and that was the end of the conversation. So here's what these 3 rules mean for you, put together in one simple picture. When confirmation of payee flags a mismatch on a payment, don't dismiss it or click straight through. It's specifically designed to catch the exact kind of fraud that cost that young tradesman his entire house deposit. Understand that your bank is now legally required, not just encouraged, to actively watch for scam patterns across your account. So if you get an extra verification call or a slight delay on a transfer, that's the law working as intended, not your bank being difficult. And if you are ever scammed despite all of this, know that from September 2026 onward, you have a real structured dispute pathway through AFCA if your bank didn't meet its obligations to you, and that pathway is genuinely worth pursuing rather than assuming there's nothing left to do. Here's exactly what I'd do this week. If you haven't sent a payment to a new payee recently, pay close attention the next time you do. Read what the confirmation of payee result actually says, instead of tapping through it on autopilot the way most people do. If you've been scammed at any point in the past year and your bank simply told you the money was gone, it may genuinely be worth revisiting that complaint now, given these new obligations sitting on banks that didn't exist before. And as a general habit going forward, treat any payment request that arrives by text or email with real caution. Verify the account details through a phone number you already know and trust, never one supplied inside the message itself, because these new systems are strong, but they still rely on you pausing for a moment when something feels slightly off. I want to be upfront about what this video is. It's general information based on current, published banking and regulatory changes here in Australia. It isn't personal financial or legal advice, and if you've already lost money to a scam, the right next step is to contact your bank directly first, and if you're not satisfied with how they respond, to lodge a formal complaint with the Australian Financial Complaints Authority. If this helped you understand what's actually changing behind the scenes of your everyday banking, subscribe for more of these breakdowns and share it with someone in your life who does a lot of their banking online, because these are exactly the rules that scammers are counting on ordinary people never finding out about.